Welcome to the 6 MIT Bootcamps e-seminar with Vanessa Coleman and Erdine Beshemoff. And we're glad to kick it off. Erdine, over to you.
Well, thank you very much, Andrew. Thank you all for joining us this week. We know that this is the week of Thanksgiving, and many of you are making plans to be with your families. And first and foremost, we wish you a fantastic time this week, whether you're celebrating this holiday or not. We are part of the MIT Bootcamps team. The MIT Bootcamp is an entrepreneurship training program at MIT, and our intention is to create a home for every gutsy innovator in the world who wants to make meaningful long-term impact. And the purpose of our seminars is to bring you knowledge from our community, in particular, knowledge from our coaches. Coaching is an essential pillar of the bootcamp program. And today I have utmost delight of introducing you to Vanessa Coleman. I got to know her as Vanessa Green when we were classmates at MIT. And I have to tell you, she was the best graduate from our class at MIT. We were in the same community of entrepreneurs who came to MIT to start companies. And in our community of about 30 entrepreneurs who are really passionate about being at MIT to start a company, she was the first, actually, who has raised venture investing. In fact, she did it way before graduation. She did it in the fall semester of our second year in business school. And then for that, she's won royal honors that will never be surpassed, and they remain forever in the annals of MIT Sloan history. Vanessa will share more about her, but I wanted to give you this part of it that she might be too modest to share with you, but I think it's important for you to know, to set the context. And Vanessa will talk to you about her experience as an entrepreneur, and it will give you a sense of the kind of caliber that we bring to the bootcamp as coaches. Vanessa, thank you so much. Greatly appreciate you being with us. Over to you.
All right, thank you, Erdine, and nice to meet you, everyone who's come to the seminar. I've never done anything like this before, so I'm excited to try it. It seems like there's a great audience of prospective and active entrepreneurs. So I put together a short presentation. It's in two parts. Basically, what I talk about is who I am, what I know about, to give you guys some background on the perspective that I bring to the conversation. And then I thought I would share some kind of tips and tricks for finding what I see as the most important pillars for building your business, your customers, your team, and your investors. As a somewhat serial entrepreneur, I get asked a lot by people that are interested in starting companies. You know, they have an idea, they have something they're excited to work on, but they don't know how to get in touch with these key groups. And I think there's some really practical tips that you can use. So that's what we're going to focus on today. I'm going to go ahead and stop the video and put some slides live, and then I'll come back on the video after we go through probably a 20-30 minute presentation, and then we can do some Q&A. So hopefully you guys can now see a presentation on the screen. What you've got there is pictures of some of the teams that I've worked on, and I wanted to go through a little bit my background and how I got started as an entrepreneur. So I came to MIT very interested in energy and water issues back in 2008. And actually, oh, wait a minute. I think I might be at the end of this. All right, there's the beginning. The very first, I guess, startup that I started was actually a nonprofit. So when I was a graduate student, I had the opportunity to do my research in Northern Region Ghana, where I worked with communities that lacked clean water access. And along with one of my fellow graduate students, we were really frustrated by the circumstance in these communities because basically the technologies existed to solve this problem. They just hadn't been implemented in a way that was sustainable. So we started by piloting a couple of small projects that were tailored to the communities that we worked in. And those projects basically set up entrepreneurial local women in those communities with businesses that treat and provide clean water to everybody in their community at a price everyone can afford. And initially our growth was really slow. It was all dependent on fundraising for each of those communities. So it cost us about $5,000 to implement a new business. And so we ran fundraisers and reached out to our networks, tried to get as many people excited as possible about what we were doing. But as we started proving out the model, we got more and more interest from other larger foundations that saw that the model that we'd established really was sustainable. So after the kind of small initial subsidy to get the business set up, it runs entirely sustainably, and the entrepreneurs have the capital from the sale of water that they need to be able to replace equipment that fails and keep the business running. And so over the past 3 or 4 years, we've scaled a lot, and we've now reached 110 communities and over 50,000 people. And the businesses are growing exponentially. So by next year, I suspect that we'll be in 150 to 200 communities. And as that happens, our team on the ground is growing as well. So our ultimate goal with Saha is to serve all 80,000 people in northern Ghana and also maintain 100% sustainability of those businesses. So that was the very first thing I started. It was very organic, no kind of venture capital fundraising involved, but has proved very sustainable, and it's something that I'm proud to continue to be involved in as it scales. So then the next business I was involved in was a company that was founded as On-Chip Power. It changed its name to Fin6 a number of years later. And that was the company I started as an MBA student when I was in school with Ardeen. And in that business, I had teamed up with a number of PhD students who were doing research in power electronics and had developed a technology that allowed us to make the power converter about a fifth the size and really lightweight. So when you think about a power converter, most people don't think about that product much, but it's the big brick that connects your laptop to the wall. And that piece of electronics is in every electronic product. So a TV, a server, a cell phone, everything requires a power converter to condition the power from the wall as it goes into the device. And the technology in that space had stagnated, and we had something fundamentally new. And so we put together a company around that business and had the opportunity to raise venture capital for that company. Over time, we ultimately raised $25 million. Coming out of school, initially the first round was just a couple of million to get us to our first milestone. And so the product you see here on the slide up in the top, it's called the Dart. It's available in the market, and it's compatible with basically all kinds of laptops. And so, it's been quite a journey, but it's also exciting to have the product out there in the market. And through the course of that, and we won't talk that much about this today because we're focusing more on kind of the early stage when we were just getting started, but we did put together a number of large corporate partnerships as well with both computer electronics companies and then in some other verticals, because basically power is power. So the same technology that we develop for laptops can be applied to other spaces. So that's a little bit about me. I think it's important that you guys have that background because that's what I've done so far. So everything I've learned and that I'm sharing is based on my experiences from building these two entities, one which is a social enterprise nonprofit and the other one which is a venture-backed business. So some tips and tricks, and you'll see as we go through this, I'm definitely going to focus on 3 areas, starting with customers. I think customers are the very most important thing for getting your company off the ground. Without a customer, you don't have a business. People have to want what you're building, and you have to know that what you're building meets a real customer need. And a lot of times when you're starting out, it can be hard to figure that out. And Fin6 is a great example of that. When we were starting, we had a technology that we knew was better. It was more efficient. It was smaller. It made the power converter a better product, but we didn't know if anybody cared. And so it was really important that we get in touch with our first customers. And there was one trick that I learned in school. Actually, it was in a sales course. Dean was giving me a hard time about this when he was looking through the slides at the beginning of the presentation, but it really works. And so I think it's worth it to share with basically all entrepreneurs I meet, is if you're reaching out to people cold, you don't know them, but you know you want to talk to them. There's a formula that gets you about a 50% hit rate. So basically 50% of the time people get back to you. Now that's pretty good. It may not sound great, but if you start high within the organization, so go as senior as possible, and then, you know, if the first person doesn't get back to you, you can always go to like the person that reports to them or the person that reports to them with no harm. It ultimately basically helped my startups get into any company that we wanted to talk to. So the structure of this is basically have the email subject and the first sentence be about them. And that can be kind of counterintuitive because you're really excited to tell them about what you're working on and why it's special and why it matters. But people are much more excited to hear about them and what's going on with them. So a lot of my subjects will be like, I see you won this award, or I see your company is, you know, has just announced this new program, so that it catches their attention and immediately they know it's relevant to them. The second sentence will tie whatever that announcement is back to your business. So I see you guys won this award for energy efficiency in lighting. This is important because my company makes power electronics more energy efficient, and I think that would be helpful to you. And then the last sentence should be an ask. So this is not like anything that can be answered with yes or no. You risk getting a yes or a no, and you have no next step. So would you be willing to talk to me? They can say yes or no. You have nothing to go with there. So always structuring the question with who, what, or when. So who would be the best person in your organization to talk to about this? What would be the best way to get on your calendar? When could we talk? What would be the best way to meet up? I'm going to be in the Bay Area next week. All of those kind of questions elicit a response that can drive the conversation forward. So I included an example here. This was a real email I sent back in 2010 when we were starting Fin6. You can see a lot of those markers that I mentioned on the prior slide. So focusing on them, then talking about our product and why it could be relevant to their space, and then asking for a referral to someone in their organization to speak with. And the who would be the best person to talk to is a great, I find, question to ask because it encourages the senior person, hopefully, that you've stalked and found their email, that you're emailing, to send your email to someone that reports to them. So then they forward it and say, oh, you should follow up with Steve. And then Steve has gotten an email from his boss, which tells him to talk to you. So you're much more likely to get the conversation that way. And you can see the response here. So obviously, he sent a short note back. You know, we were not at that time ready for mass manufacturing, but he was excited to talk to us, and we were able to continue the conversation and ultimately ended up getting a letter of intent from this company to buy our product when we produced it, which helped us a lot in fundraising. So the next thing I wanted to talk to about customers was the use of quick and dirty surveys. It's something that I've done in every company that I've been involved in as a way to learn more about the market. Obviously, you can talk to, you know, thought leaders and people that you might be able to connect with that are in this sector. But it's also, you know, for us, we were building a consumer product, so it was important to understand kind of the perspectives of the customers that we would be targeting. And, you know, some people can be afraid to do this because you're like, oh, well, it's going to be biased because no one's going to want to respond to my survey and it's just going to be my friends and family. And maybe it is. But if you do reach out to your whole community and say, hey, like, I'm excited about building this thing. As long as you keep your survey short, ideally less than 5 minutes, people will take the time to do it. And in our case, we had 200 or 250 people get back to us. We did promise them all a discount on, you know, the first product when we shipped it, but it gave us a lot of great information. So from that survey, we collected information on demographics. So we were able to like segment our customers and understand like the kind of attributes of the customers that were most likely to buy and pay for a product like the small charger that we were building. And so, you know, we were able to build out our customer profile that way. And then also we used it as an initial test for willingness to pay, using a conjoint analysis. And I'm not going to get into that here, but having some information on the fact that people appeared to be willing to pay $20 to $30 more for a small portable charger was very helpful to us, both in forming some of the corporate partnerships. You know, the big electronics companies were interested to hear our research in that space, and also for us in thinking about how to price the product and whether it really made sense to go into that market. And so I just want to kind of encourage everyone, SurveyMonkey's free, you know, get as much feedback as possible, as early as possible, and the more data you can get, the better. So the next thing I wanted to talk about after customers is team. And I think you always hear it's a huge commitment. Think of it like a marriage. But I look back and you can see this is pictures of me with my co-founders in the year the business was starting. So it's now almost 10 years after I started the nonprofit, and it's been about six or seven on the company. And I've worked with those people day in, day out over that whole period. So for me, it's been the longest kind of relationships I've had, professional or otherwise. And it's really important to build trust and build an understanding of the people that you're getting into business with on the outset. And you can see that, you know, over time, there's been a bunch of changes. You know, people have come and gone, the company's names have changed, board members have come in and out, but the co-founders are kind of a huge part of making kind of all the blood, sweat, and tears that goes into building the startup. And so finding the right people is really important. And one thing I want to say about that is that if there's any way possible to get a chance to see your co-founders kind of in action, whether, you know, working on a project or even, you know, organizing a conference or helping with a club before you work with them, I would say to take the time and the opportunity to do that. You know, there's so many things you can learn about how people work and how they work with you from having a chance to see how they operate and see how they handle stress. And so, you know, look for those opportunities and think about whether they're people you can trust, whether you share values, how you communicate. Are you able to be open and honest with each other? Is there confrontation? Does their style work with yours? And then do you share a vision for what you hope this could be? Because many times one co-founder will have the idea that, you know, they'd really like to flip this and, you know, make $1 million and be on their way. And the other ones have an idea that they want to build something really lasting, and this is what they want to do for their career. So having those conversations early really proved valuable for me in both contexts. A little bit about how I went about finding my co-founders, because I get asked that a lot too. I do feel like I was very lucky. In both cases, they were other people at MIT. So I was in school there and I was able to interact with them through courses and clubs and things that I was involved in. now being out of school, thinking about if I were to start a new business, where I would find my co-founders. What I would be most likely to do is attend events and meetups that are in the space where I'm interested in starting a company, understand who's there, and then talk to as many people as possible that have worked with them. The other thing that I do is I talk to people in my networks about what I'm interested in doing next. And as I do that, they say, oh, I know this person, they're really interesting. They're, working on this, that, or the other thing. I think it might be related. And so I found that to be another really good way to meet people. But I think it's one of the most important things you do in starting a new company. And then the next thing I wanted to talk about was advisors, because there's definitely nothing that can trade for experience. And one of the great things about getting advisors around your company is that they have a whole bunch of different experiences that you haven't had. And sometimes that can be really challenging to manage because at least I found that advisors tend to come with a perspective. An example of this is when we were first raising money for Fin6. This is kind of some of the advisors we had around the company. And I remember one of our mentors from the Clean Tech Open gave us this whole spiel about how we had to raise angel money because we weren't far enough along for venture, and angels would provide the right level of support for where we were with the company. And we needed to work with angels, and that was the only thing that made sense for us. In the same time, we had another mentor through the MIT Venture Mentoring Service who basically told us the exact opposite. They said, angels are great, but this company is going to have to be well capitalized in order to succeed, and angels are never going to be able to provide the capital you need to grow your business. And so we had to take all that advice and think about what made sense for us. And ultimately, we ended up building an initial investor syndicate with some angel investors and some venture investors. And we're able to see the pros and cons of working with both types over the course of our startup. But I can't say enough about how much I gained from talking to as many people as possible about the idea. And some people will shoot it down. A lot of people will doubt you. A lot of people will say it's impossible. We heard, more times than I can count, you're never going to be able to do this. You don't have the right experience. But usually there was a nugget in there of something that was a risk that we should look out for, something specific, something that we could help mitigate. And so finding advisors that I trusted, I think was one of the most important things that we did early on. And I guess one last thing I wanted to say about this is how we went about meeting these people. Again, you can see there was a great MIT connection, but as we got kind of out of school and we're building our business, we really needed to meet people in the industry. And so there's industry events for basically everything you're trying to do. And what I would do before any of those events is I would kind of stalk out who was going to be speaking there, which companies were going to be having booths, maybe what recent announcements they made, and what the individuals looked like that I wanted to talk to. So I would have that kind of all in my head. And then when I went to the event, I would go around and look for those people. I would go to the talks that they were at, make sure to talk to them afterwards, get their card, ask if it was okay if I followed up. And where it was a booth, I would come by their booth. And if the actual individual that I wanted to talk to wasn't there, I would just pass by and then come back later to make sure that I got myself in front of the people that we needed to connect with to grow the business. Oh yeah, and one more thing on that kind of stalking phase. I guess the other thing that I would think a lot about is ways that we could potentially help them. So was there something about our network, something about this piece of the space we knew, something about where they were heading that maybe we could help them get there faster or beat their competition. So always looking out for ways in which we could help people, and in doing that, make ourselves memorable. So the last piece here is on investors, and I think there's a certain emphasis when you think about startups in the pitch and putting together a story and selling to investors. And I think in some ways that misses out an important step that can happen even before the pitch, and I think has been one of the most important pieces of the fundraising process for us. And that's getting to know the investors outside of the pitch meeting, both so that they can kind of build their knowledge of you and start to build kind of trust and confidence in the way that you're building your company, and also so that you can get to know them and see how they respond to things, meet other entrepreneurs that they've worked with, see those companies go through ups and downs, so that you can build an understanding of how those investors respond in stressful situations. Because as investors, particularly if they're large investors, they're likely to be on your board, and they're likely to be driving the discussion around how you're building the company. And so, having knowledge of them and what matters to them can be really important as well. And so one of the things that, you hear this, if you want money, ask for advice. But then what does that really mean? What do you want to talk to them about? And so I included here some of the things that I found most helpful. Whenever you're raising money, you're going to be raising money to a certain milestone. So, people are going to ask, what are you going to achieve on this money? Where are you going to be at the end of this funding round? And so talking to investors casually about that, saying, hey, I think, we're targeting this milestone. This is why I think it will create value. What do you think about that? They might have feedback on, oh, that's going to take you, from what I've seen in my other companies, twice as long as you think. You should plan for that. Or, that's not really the value. Getting the product done isn't the value creation event. It's getting the first customers. So you might want to size your milestone that way. I found that to be a good discussion topic. And then understanding their perceived risks. So what do they think is high risk about what you're building? And sometimes that can be informative for you. Even if you don't end up working with them, you can learn something and de-risk your startup, which is always, at least for me, what I wanted to be doing at every stage. And, as they think about the space, they've likely talked to other people that are building companies in adjacent areas, and they're not going to disclose to you the details of those companies. But, they will say, oh, we've seen several companies that are 6 months from having a product. It seems like you guys are further out, or, other companies are going to achieve X if they deliver. And so that you can use that to get a view of kind of what the world might be in the future. And then also sharing your own expertise in the space. And investors, at least I've found, are always looking to learn and be smarter about things. And so, sharing your knowledge of a market or how you've seen things evolving where it's possible, I think can really help kind of build a relationship and a rapport. That said, I think it's important to not share your secret sauce. Often, investors will be kind of asking for that very early in the process. And, I certainly as an entrepreneur felt pressured sometimes to share more information than I felt comfortable with. And there were certainly circumstances where that information was used by that investor to my disadvantage, whether it was shared with a competitor or, created a new competitor because, something was kind of pivoted into our space where it wasn't there before. It is a risk. So I don't want people to be paranoid, but you shouldn't necessarily kind of tell people everything, particularly early in the conversation. So after, so thinking about talking to these investors. If you can, in this phase, if you can meet them kind of at events and conferences and get to know them, that's great. But if you're to the point where you really want to be making your pitch and you want to talk to certain investors, it's really important to get a warm intro of some kind. And I think it can be hard to think about how to do that. Maybe you feel like you don't know anybody that knows the investors you want to talk to, but using some of the techniques from the kind of how to reach out to customers side, hopefully you can find some kind of a connection either through your school or through other entrepreneurs to investors in the community. And then once you find someone who can make those connections, you want to make it really easy for them. And so I wanted to show you kind of how other entrepreneurs do that. And definitely in my networks, this is a really common structure. So this message is something that was sent to me explicitly that I could forward to the investor to which this person wanted an intro. So it's addressed to me, but it's written really for the investor. So it says, hey, I'd love to talk to this investor. As I mentioned, our round is moving along to create some sense of urgency. And then a very brief description of what your company does, who you are, like things that make an investor want to talk to you, and kind of where you are in your process. And then some kind of a link to, you can see here, there's information on the team and a CAD model. Often you'll attach an executive summary or something like that. And then, the person to whom you're asking for the intro will take this and forward it and say, dear so-and-so, in this case, I hadn't talked to this investor in like a year and a half, but I was like, so-and-so saw that we were connected, and I was talking to him about his business and we thought it could be a good fit. I hope you guys are able to connect. And the VC took the meeting in this case. So I think that that's a common outcome when you are able to set up an effective warm intro. And I thought this was really well done. So I just wanted to share it with you because this is something I've certainly used to meet investors. And so after the initial meeting, I think this is something that I really struggled with initially, and it actually wasn't until our second or third round of funding that I got really comfortable with the process. But at a venture firm or an investment firm, the POC is your point of contact. Once they're excited about what you're building, it's really important to give them the tools to be your advocate to convince the rest of their partnership to invest. So that's something that kind of, it's like, oh, I've sold them, they can deal with the rest. And they can, but you can definitely do things that help your case. So what they typically do first is they'll bring in some of their other kind of like friends and close associates at the firm to meet you in small meetings, ask questions, kind of build a coalition of people that are interested. Then they have to put together an investment memo. So anything hard that they're asking you, they're trying to justify to their firm. What are the risks? What is the capital required? What additions to the team do you need to make it succeed? All of those things, they are putting together a memo to justify the investment to their firm. After that, they're going to bring you back in to pitch the whole partnership. And that's a pretty important step. Typically that would happen 3 to 6 weeks after your first meeting with them. And at that point, there's kind of typically a yes or no decision. Occasionally the partnership will have a concern and want to bring you back. But typically once you've pitched the broader partnership, there's a yes or no. And then you'll get a term sheet. That'll spell out the terms of the deal. I'm not going to go into the details of that here. I'm sure it's something that's covered in other phases of this. And you should expect a couple of weeks of negotiation. Then once you sign the term sheet, there's still 60 days until the closing, at least. And that was something that we underestimated initially, because we said, oh, once we get an investor, then we'll be funded. But it actually can be up to a quarter from when you secure an investor until you actually have the cash in the bank. we found going through the process that it's pretty important to move multiple investors through in parallel, because you could see like the last email we just looked at, investors get motivated by a competitive process. So for them, they like to wait, because if they wait, there's always more information about how you're doing. You get past more milestones, you grow your team or not. So there's never really an advantage to them to actually jumping in and funding your company unless they think they're going to lose the deal to somebody else. And so that's why we found it was important to move multiple firms through the process at the same time. And what does that actually look like? So in the case of Fin 6, it was a slog. So for our first round, we made over 60 first pitches. That turned into probably 8 partnership meetings, and then ultimately 2 term sheets. And so you hear no so many times. And I know people tell you that, but it's still hard to stick with it when that's what you're hearing over and over again. And, I put this comment here about marriage too, because once you've gone through that whole process and, maybe you have a term sheet from a firm you don't really trust, but it's the one you have and you're exhausted, it can be really tempting to take that deal. But then you have to remember that you're going to be stuck with these people for the next 2, 5, 8 years. And so making sure that you retain a clear head through that process is really important as well. And I would say, it's a slog on at least for us, it was a slog on the venture side, but it can be even harder for the nonprofit. And so I always think of it's about 100 times harder to raise money for a nonprofit. So, and with that in mind, it's equally hard to raise like $10K for Saha as it is to raise $1 million for a startup where you can kind of appeal to greed and the opportunity for a huge financial return. It still is easier to raise money in that environment than in a non-profit context. So I think that's probably about enough for me. These are just a quick summary of what we covered. I think customers are the most important. If you can get cash from them, it's great. We did some of that at Fin 6. It was awesome. And also you can learn about market, make sure you're building the right thing. The team is the people you need to make it happen. So finding the right ones and making sure that you have trust there is critical. And then you need investors. It can take some determination, but finding partners that share your vision from the investment side sets you up to be able to build the company you want. And so, I think for me, those are the kind of fundamental pillars to actually creating a business. So I guess we will go to Q&A. I'll turn my camera back on maybe. Here we go. There we go. Hello.
Vanessa, thank you so much for this. This was fantastic. Let me start with questions. And first of all, I want to thank the participants for asking the questions. I can see that some of you have asked many. And in fact, I have seen some of you on our previous e-seminars. Thank you for being with us. So often, one of you is Sorcerer. I don't know who you are really and what the real name is behind the Sorcerer. But Sorcerer, thank you so much for asking so many questions. And my first question to you, Vanessa, and it encapsulates some of the questions that our entrepreneurs ask is, what are the first steps you take once you have an idea? A lot of questions really come down to this. You were in new enterprises and you met Tony and the team, and you had a sense that, hey, there might be something special here. And so the question is, what is it that gave you the sense that there might be something special here to which you want to dedicate yourself? And secondly, what were the first steps that you took to prosecute this opportunity?
So, For me, it really is a combination of the first two factors that I was discussing. So the very first thing that in all cases was we talked to the customers that we plan to serve. And in the case of Fin6, it actually caused us to change markets. So when the idea first came to new enterprises, it was targeted at envelope tracking to make cell phones more efficient, which is a really interesting application. It's a place where power converters are used, and it was a space that I knew nothing about. So I knew there was some technology there. I'd met the team, I liked them, I was excited to work on it as a project, but I wanted to know whether it could be a business. And so we went to a meetup for the mobile space because I didn't know anybody in mobile. And we, started talking to people there, and some people who had worked in the mobile phone space, and even some component suppliers into that market. And we quickly learned in the course of about 15 minutes that there was about 3 well-funded startups that were 5 years along solving the same problem. So it was like, okay, well, that's not a space we want to go after, because there's not going to be a market there once we get there. And so then, we went back to the drawing board and said, where else could we take this? And we started talking to potential customers, using some of the techniques I described in lighting and electronics, and trying to understand where people valued what we were building. And so through that process, I both got to know the team and understand if I want to build something with them. And I came to understand whether there was something really of value there that the market would value.
Gotcha. And you ended up raising quite a bit of money for Fin6, but we have John Hansen here who is asking a question about bootstrapping. And John is a graduate of our bootcamp. He was in our recent bootcamp in Australia, and he's been a very successful alum of the bootcamp, having founded a company called Quick Claims. But he's asking, have you considered bootstrapping Fin6? Was this viable?
So for Fin6, we did discuss it. I think anytime you have that opportunity, you should look for it. It aligns the incentives, I think, better with the entrepreneur. And particularly if you have customers that are willing to fund you early on, I think it's a great way to think about it. In the case of Fin6, we needed to develop a chip, so a semiconductor component, in order to realize the technology. And so the development of a chip was going to be at least $3 million project. It actually ultimately took about 10 million. And so, we weren't in a position where we could access that kind of capital from, anywhere other than venture type investors. That said, later on in the course of Fin6, we were able to put together some larger deals with electronics companies where they were kind of paying us for the development of the product in exchange for some limited exclusivity in their space. And so, I do think that there's sometimes opportunities to do that. It just, depends if you can get far enough on the capital you have to be able to get those partnerships.
Okay, thank you. And now I'm going to progress into questions that many of the participants are asking, and that has to do with the investment process, which you laid out so well. You made a statement that you are going to have to go and talk to a lot of people and share what your idea is to find the right people, the right firms with whom you'll move forward. But at the same time, you said, be careful about divulging your secret sauce. What's in your view a secret sauce? How would you describe it, just so that participants can think of it conceptually? And secondly, when in the process do you get comfortable to divulge some really important information about what you do?
So for us, and I think this is a little bit unique to Fin6, our secret sauce was stuff that could be patented. So it was unique techniques for making power systems that were captured in a host of patents that we filed. In this case, one of the challenges that we dealt with was that the filing process is long. So even after something's filed, it's not necessarily visible to the market or actually an approved patent for a number of years. And so there's this kind of filed IP but not issued patents gray area, where, if you're sharing too much of that information, maybe, particularly in talking to strategics, your competitors or partners might know where the technology was going. And even in, a lot of our strategic partners were customers, but they might be talking to others of our competitors, and they might have relationships with those and those other people that we would perceive as competitors. And so we wanted to be thoughtful about what we were sharing. For us, we typically kind of explained the differentiation, like why our product was better at all stages. And why we saw a market opportunity there. I do think there can be risks around divulging too much about the market, particularly where you have, unique information, but that was something that was less of an issue for us because that wasn't where our core competitive advantage was. But then we wouldn't share the details of how we did that. Sometimes we never actually shared it. And, if we were talking with an investor that was more technically competent, it would be, in the detailed diligence phase, kind of around the time of the term sheet, and sometimes even not till after the term sheet, just depending on the investor and what the nature of that was.
And here we have Karen Ziegler asking an important question that many entrepreneurs ask. I remember asking this question myself. How do you know how much to raise? How much money you needed?
So I'm laughing because, there's the conventional wisdom that's like, figure out how much you think you need and then double it. That definitely held true in our case. When we sat down and thought about how much we needed to get to our first milestone, which in that case was going to be an engineering sample for the first product we were building, we kind of made a list of everything we thought we needed to do and, the team we needed to have and how long it would take, and then we doubled it. And it actually turned out that we needed double of our doubling to get to that first milestone. And so, I think that there is some wisdom to that. And I think the other thing that I find helpful is breaking it into chunks. So what is it that you want to achieve? Something that is concrete that you kind of feel comfortable estimating to, and just focus on that first phase. You can say, you'll need more money after that. You expect to need to raise further rounds, but investors don't expect you to know, exactly what you're going to need 3 years from now, but they do expect you to have a point of view on what you need over the next 12 to 18 months. And so that's something that I find to be a little bit more relatable, because you can envision, how big the team will need to be and what you might need to pay people and what that might need to look like in a closer time frame.
Gotcha. And, when you went to the investors, obviously you had a certain narrative that you were promoting about you, your team, Fin6. But to turn the table, what do you think about your story and Fin6 was attractive to the investor? And do you think there were differences in, what your story was and what you perceived as the value of you and Fin6 and what the investor actually invested in?
I think in most cases for us, the investor was investing in the potential for the technology. And in our case, it was a well-known research group. So the kind of advisor for some of my co-founders was someone who, had done good research and had a number of other startups that had not yet exited, but, were kind of coming up. So I think that research group was attractive to the investors. And also they saw a strong technical capability in my founding team. So it was actually not me in that case. I was just the person packaging it, but it's actually the kind of capabilities of my co-founders was one of the things I think the investors were actually investing in. And I think, some of the things about the market and how we were telling the story about the opportunity. They discounted a little bit because they assumed that we would learn more about that as we developed the product and, you know, as we built kind of our first proof of concept in that early phase.
For the moment now, I'm going to step away from the financing process and talk about the entrepreneurial team formation process. And there is a question that Alexander Kerbel is asking. Forgive me if I'm mispronouncing your name, Alexander. But you're asking a question again that reflects a situation that's common. You've got a team of potential co-founders, but not all can work for equity only, meaning they cannot leave their jobs, or they're still in school, or they can drop out. And so this creates a situation where you are kind of committed, but kind of not. What do you do?
Well, I think obviously it depends on the circumstance. We had that situation a bit because we were all finishing school when we were starting the company. And so we talked a lot about what would be the triggers for people going full time. You know, was it raising money? Was it graduating? You know, at which point would they have to take another job? And I think having those honest communications about it helped us kind of understand where people were at. But I think, you know, for us, we were fortunate in that everybody was willing to jump in full time as soon as we raised money. And then we were able to raise money. So we didn't have to deal with any of the situations where we were really dragging along a quote unquote co-founder who wasn't pulling their weight. And I know that that can be something that's really difficult to deal with. You know, other, you know, friends and people in my community that I've seen that have that challenge, ultimately seem to do best when the people who are committed full time, you know, have the difficult conversation with the one they're kind of dragging and say, hey, this, you know, isn't working out, or, you know, I feel that this isn't balanced, or, you know, if you're only going to be able to give this much, we need to scale back your equity, or, you know, we need to structure this differently. And, you know, where it can get to a point where everyone feels like their contribution is valued appropriately, it can be successful. But, you know, if you do have someone who's doing a lot more work, or, you know, carrying a lot more of the weight, whether financially or time-wise, I think it's important that that person's valued appropriately. Otherwise, resentments will build and your, you know, coalition of co-founders will fall apart.
And let me ask you about role designation in a startup team environment. In the beginning, you were peers, and your team chose you as the CEO. And that is interesting because you are not the inventor of the technology. And I think it says a lot about you that the team of engineers designated you as the CEO. But share your thinking on how to think about roles. Who should be the CTO? Who should be the CEO? How to talk about it? What matters in a role?
You know, I think it's interesting because I was designated as the CEO, and I think the word designated is actually a really appropriate word in that case, because it was early enough that we more assigned me the CEO so we would have one, not because, you know, it was necessarily the most well thought out structure for us. And in our case, I think I was assigned the CEO role because I had most of the relationships with the investors. And so I was having most of those conversations. And so that was how it evolved. But there are times when I've wondered if, you know, we might have been more successful with my really strong technical co-founder as the CEO and me as like a chief of operations or business development, where I was, you know, where we were structured in that way. So, you know, I do think it's a good question, and I don't think that there's a right answer. We did find that investors were looking to have kind of a single point of contact as a CEO that they could talk to. And then beyond that, there was very little kind of concern about what roles were assigned to others. And I think that that's worth mentioning because, you know, the engineering team operated as a kind of on a consensus-based program for a long time. And even as we started to grow and got up to 5 or 6 engineers, because more than half of those engineers were co-founders, there was a very kind of consensus-based mindset. And I think it was frustrating and added cycles for us because there wasn't kind of a clear kind of hierarchy and structure early on. So I don't have the answer, but I do think it's kind of important to think about, particularly when you have more than 2 co-founders. And we had 4. And in my nonprofit, there was just 2 of us, and it was really natural. My co-founder wanted to do it full time. I wanted to have a kind of a part-time board role, so she took it on full time, and I remained on the board, and it was very natural, and there was never any question about it. So, you know, it obviously it's a critical point, and I don't have the right answer, so I'm interested to hear what y'all think at Bootcamps as well when I come to the program.
Well, the good news is, Vanessa, there are a lot of questions for you that I'm looking at now. The bad news is we're coming to the end of our time, and we're all heading into the Thanksgiving week. And let me ask you one last question. Your journey has been impressive, and I personally look forward to tracking where you go. There is much more, I believe. And you went to business school. In business school, they teach you how to be a CEO. What didn't you learn in business school that was very important in your CEO role that life teaches you?
Let's see. I think a lot of the things about people, and in business school, you get the opportunity to hear from a lot of great leaders. And so you get to hear how they do things, but you don't actually get a chance to try to motivate your team and to try to navigate through pivots and difficult situations and maybe investment rounds that don't come through and products that ship late, and all of those types of challenges. And so for me, kind of building my confidence in kind of my leadership style and my capabilities was definitely something that I got through experience, not through school. So, I would try to apply what I'd seen or read, and sometimes it worked for me and sometimes it didn't. And so, having that practice has certainly made me a better leader in the years since I graduated. And I still have a long way to go, I would add.
Well, Vanessa, I want to thank you for your time. This has been fantastic. I want to thank Andrew for the organization of the e-seminar. Importantly, I would like to thank you all for being here, for asking the questions. Best of luck to you all. Our upcoming bootcamp is in Australia in mid-February, and our bootcamp after that is in Rio de Janeiro, Brazil, in the last week of July 2018. We look forward to you applying to the bootcamp, and we look forward to you all being at the bootcamp. Thank you all so much. Andrew, thank you again. Vanessa, kudos to you.
Thank you. It's great.
Bye for now.